You're about to join Jerry Parker, Moritz Siebert, and Niels Kostrup-Larsen on their raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor podcast series.
Welcome to this week's edition of the Systematic Investor Series with Jerry Parker and me, Niels Kostrup-Larsen, where we share our knowledge and sometimes painful experiences of what it's like to be a rules-based investor, and where we end with some Q&A-based questions as we want it to be a listener-driven show. Moritz is out this week, so good morning, Jerry. How are you doing?
Doing well. How are you doing, Niels?
Yes, doing great here on this side of the pond as well. And if you're tuning in for the first time, welcome. We love that you are here, and we'll certainly do our best to inform and perhaps even entertain you about systematic investing during the next hour or so. Now, before we start, I want to give a big shout out to Clark JR6, Nickname 2, and AP Murray, who all jumped into the US iTunes store this week and left some very nice rating and reviews. We highly appreciate this, and of course, also a big shout out to everyone who took the time to do so in their local iTunes store. And allow me just to share these reviews with you, because I think they may be useful for listeners who are new to the show. So the first one came from Clark JR6, who wrote, "Of all the market-related podcasts out there, TTU stands out. The content is absolutely fantastic. It has become my go-to source for trend-following information and encouragement, which is needed at times as a systematic trend follower. Keep up the great work." Thanks so much, Clark, for this. Nickname 2, he wrote, "I'm not a trend follower, but the discussions are smart, nuanced, and should be of interest to any trader seeking deep market insight. The program has also increased my appreciation for the trend following approach, which per the participants here has necessarily become more sophisticated than its turtle or origin." Appreciate that very much, Nick. And finally, AP Murray, who left also a nice rating and review. He writes, "Niels, Moritz, and Jerry do a great job recapping the week in financial markets, sharing wisdom and experience along the way. Whether you're a trend follower or not, this is a weekly must listen. Thanks, guys, for sharing the journey with us." So again, thanks so much, Mr. Murray here. And by the way, we have actually made it hopefully easier for you to support us with these reviews. You can just go to toptradersunplugged.com/review, and that should only really take a minute or two to help us out. Now, let's jump back to this week's review of the markets and things that caught my eye. During the week, fixed income markets really around the world continued to recover from the sell-off we saw in the beginning of the month. At the same time, we saw energy markets fall back to where they were trading prior to the attacks in Saudi Arabia. But in terms of interesting new highs, I noticed that yesterday the dollar index actually got back to levels we haven't seen since early 2017. And all in all, these moves, which were more or less, or this week's moves, which have been more or less in line with some of the bigger trends we saw leading into the end of August, I think overall have helped trend followers. And also on our side, it has been an okay week. And let me just stay with that before we jump over to you, Jerry, and hear how things were on your side. But, not surprisingly, it has really, profits from this week has really come from the fixed income markets and the energies and the currencies. So those sectors have worked out well during the week. While we've seen a little bit of, downside in terms of performance from softs, particularly in sugar. The meats didn't do well either. Gold was also a small loser, and some of the equity markets. But overall a positive week, nothing too exciting. But also when I was reviewing the news flow this week, a lot of things are still centered around the usual topics like the trade war, where Trump apparently now are talking about delisting Chinese equities. There's another investigation into himself this week. Talk a lot about that, impeachment, etc., etc. We have Brexit on this side of the pond. We have the Fed and the repo debacle that takes up a lot of time in terms of commentators. And we have also this week a lot of news about disappointing IPOs and some that are even being stopped altogether. So the list is long, but it's kind of the familiar points that people are talking about. So I'm not going to go into any details or views on that. But of course, all of this is taking time and focus away from dealing with the real issues that many economies are facing. And it's maybe not surprising that we saw the former Fed chair, Janet Yellen, on Friday. I think it was at an event at Georgetown University where she said that she believes that the Federal Reserve's estimates for long-term economic growth might be a little bit too positive. And she was citing three factors such as demographics, education, and productivity, which is probably not what the kind of news that the central banks and policymakers are hoping for at this time. So not so much real meat, I would say, this week in terms of news that really moved the markets. Biggest movers were things like lean hogs, up 15%, but I'm sure a lot of people may not follow things like that. We had obviously some downside pressure on energies, but nothing else really stood out to me. What about you, Jerry? What caught your eye, and how was your portfolio? Any big changes this week?
Oh, no, not too many big changes. My long-term systems kind of prevent the big changes. Just some of the things I'd add to what you said is some of the currencies, smaller or emerging market currencies are stronger. India, Israel, Turkey, Russia, maybe not making new highs, but hanging in there and not making lows versus the dollar. So a little bit different in Europe and Canada, Aussie, New Zealand. So that's good because I have those currencies, and it's good to have more diversification. I think I was like Sam, who mentioned a few weeks ago that had a debacle in February, I think, because he lost money in every single currency, which I think I might have as well. So it's good to see some diversification pop up. Not happy with the gold and silver sell-offs and the volatility there. I guess those trades are probably going to have a big week. Are they going to hang in there, recover, or have we seen the highs for a while? And I think Bitcoin, the uptrend in Bitcoin is in doubt, let's say. I'm trying to choose a word that could cover me, but it looks shaky. My first Bitcoin futures trade doesn't look good. So, but like you said, it's a mixed bag. I'd much rather be long and short all the different markets than just a few positioned long, let's say, even though stocks continue to do well. And I probably had a few buys and a few short liquidations, but nothing big in the stocks this week.
No. Well, we can't have excitement every week, and as many people know, doing trend following is usually not a very exciting thing to do anyways, but keep the focus, do the trades. That's really how it works. I also have to thank you, by the way, Jerry, for sending me the news about HedgeWeek, who announced their 2019 USA Awards, and apparently DUNN Capital, our company, was named Best Macro CTA Fund, which of course is that's great news. But I wasn't even aware that there was a category called Macro CTA Fund. But maybe this is a kind of a new description that firms like Chesapeake and Dunn we have to get used to. I don't know. What are your thoughts on that?
Oh, I think it's fine. I'm kind of anti the term managed futures because I don't think it's very descriptive, and I don't think it was created by CTAs. So I think systematic global macro CTA is just fine. I mean, I like CTA because people have a tendency to know what it means. It's like IBM. It has nothing to do with what they do now, but IBM's not going to change their name. It's kind of, we know what IBM is and has a long, glorious history, as do CTAs. We don't trade commodities like we used to. It's a minority of what we trade now, but that's fine. So I think anything that kind of is more descriptive and gives people a better indication off the cuff of exactly what's going on here. So I'm fine with systematic, global, macro, CTA. Those are all good words because it's what we do.
Yeah, no, very true. Also, it reminded me of a recent paper I read from Mercer, the big consulting firm. And they are now trying to introduce 3 new terms to describe the strategies when they talk to their clients. So they now talk about pure trend, diversified trend, and multi-strategy. And they define it by pure trend being that the underlying models or allocation inside the program, 90% or more to trend following, then you're pure trend. Diversified trend is 50 to 90% to trend following strategies. And then multi-strategy is less than 50%. And they go on, and so they talk about that in this paper, and then they go on to put that also in relation, and this is maybe where I kind of disagree a bit. They go on to put that into buckets of, okay, so what should you pay for this? So if you're unfortunate enough and fall into the pure trend category, they think that you should only be paid a base fee of 50 to 80 basis points and no performance fee. I don't know if they say that you should pay, but that's how they present it in the paper in terms of buckets. The diversified trend followers, so if you can get into that category, you should be able to charge 100 basis points or 1% management fee and up to 20% performance fee. And if you are in the multi-strategy camp, you should be able to charge more than 1% management fee and maybe even more than 20% performance fee. So I have some problems with that, but I wanted to hear your thoughts, Jerry.
Well, it's early here on the East Coast, but I'm totally awake now. I don't like any of that. It's horrible. For one thing that I don't like, and I think you and I have talked about this, and you and I are probably not on the same page on this all the time, but I don't like calling trend following. I don't like assuming that trend following is the CTA portfolio. I like trend following is trend following. It exists in currencies only, stocks only, commodities only. It exists in all the markets together, long and short, long only. Trend following is trend following. Trend following in stocks has worked incredibly well. Diversified trend following has not worked that great. The typical CTA portfolio that is diversified, it's not 100% trading the stock market or just taking the long trades. So now they've said, well, no, that's not diversified. Diversified is the systems that you're trading. Is it all trend? Is it 50% trend and the balance being mean reversion, short term, carry trade, blah, blah, blah. And so then they're so presumptuous to go in and say, well, here's what you should be charging. I think most of the time you sort of get to charge based upon, the Sharpe ratio or your drawdown. So if you have a smoother return like DUNN might have, then maybe you can charge more than Chesapeake, who doesn't have a smoother return because it's mostly trend following. But this is sort of market determined, client specific, manager specific. Yes, I don't like this idea of they're going to decide and come up with these new names that are misleading and sort of try to tell us what we can charge or what clients should be paying. Yeah, I don't like any of that.
No, I agree. I mean, but just as a quick comment, I wish we had more smooth return than you, Jerry. But I think we're in the same camp when it comes to embracing volatility and accepting volatility in your returns. But I also find it extraordinary because essentially, again, where does it come in that you should actually pay for what you get, right? So if you get a great return, doesn't really matter, whether it's 51% trend or 90% trend. If you get a great net return, from your manager, why not pay them well, right? Just because we use, and we talked about this with Peter Borish. I mean, clearly we have, as an industry, done a really poor job by saying to people that what we do is simple. It's not simple. But what we have managed to do is to take something that's incredibly complex and put it into relatively simple rules. But to do it, to implement it, to do it, and all the other things we have to comply with, I wouldn't say it's simple, but I think it's crazy that you should be charging depending on just the different kind of strategies. I mean, you could deliver a crap return, pardon my French, and still get to, just because you call it a multi-strategy, you should be allowed to charge more than a trend follower who does really well and delivers good returns. I mean, that's crazy stuff in my opinion.
Yeah, I agree. And I wanted to get back to what you originally said, the global macro, that first thing you said about the new description. But I left out the most important part, and that is that I like this idea that part of that was hedge fund, because we are part of the hedge funds. We've sort of been pushed out of the hedge fund label sometimes because we don't trade cash equities all the time, and we're not sort of stock-centric. But if of all the different hedge fund strategies, we've got to be the best hedge because we trade the most markets and we go short, and we'll actually be short stocks. And we're not highly correlated to the long S&P anyways. So I think picking up that part, making that a part of our description is a very good idea. It's a truth in labeling, because we really are the best hedge out there. Trying not to say crisis alpha, but over time, over bear markets, we're a great hedge. Plus, we have a tendency to make money, unlike some of the other hedges. And I think another thing, too, is that I had most of my career, I had lots of volatility. But this strategy, trend following, longer term trend following with all the markets, currencies, commodities, stocks, bonds, long and short, is very reliable, and it's very consistent. So there have been times where I made a decent return and had tremendous volatility or drawdowns, and but we just were very consistent at making money annually, and my clients could care less. What was the drawdown? In 93, we made 60%, and someone once told me, well, John Henry made 65%, you made 63%, but his drawdown was bigger. And I was like, look, in 1993, that's not one single client of his or mine could tell you what that drawdown was. They could care less what the drawdown was. But the consistent annual returns, which, prior to the past 10 years or 5 or 10 years, we were excellent at doing. And I think we can get back to that level because we just have, the odds are in our favor with our strategy and with all the markets. So consistency and being able to deliver a return like we used to, if we get back to doing that and the markets kind of get back to more trendy, then once again, I think some of the ratios and numbers will be forgotten, as they should be.
Yeah, no, absolutely. Let's leave that for now. I'm sure we'll come back to this discussion as we move along in our trend following journey. I wanted to give a quick update on our live event, which is almost sold out. But we had some exciting news to share with people who are coming. But also maybe if there's one or two people still on the fence, this might make you more interested. I don't know. But we're actually going to have a very special guest at the event who will come and help us with the mental side of the things. And it's actually Denise Shull, who I think a lot of you may have seen maybe on TV, not on TV, on shows like Real Vision. Where she does a lot of great interviews there, but also as some of you might know, and I don't watch the series myself, but I know you are familiar with this TV series Billions. But Denise also worked with the actress who plays the trading coach inside the firm. So I could not be more excited about having Denise coming and spend some time with us at the end of October in New York. I think this will be really important for the group and for us. I mean, it's something that you probably never grow out of. Having to work on your mental side, especially when you're in this game. So I'm excited, Jerry, and I know you follow the series as well.
Oh, it's a great show and a great character, and I can't wait to meet her. And I think this is a great idea to embrace this whole idea. And when I started watching the show, I thought, what a great idea that to have a coach and someone, a counselor to talk to, because the markets are very stressful. And even when you're following a system, one of the keys is to remain disciplined and do the trades. And so getting some ideas on how to continue to do that. You can keep telling yourself, buck up, be better, do more. I mean, I don't think this is how you create better mental health, just by yelling at yourself and criticizing yourself and telling yourself to do better. It's probably a lot better ways than that. So I'm looking forward to it. A very good job on getting her to come, Niels.
Yeah, absolutely. This is great. Okay, let's turn our attention to your activity in the social media world. There's always some really good insights that you pick up and share. So I know you've been busy this week, maybe with other things. So did you still have time to do a bit in Twitterland?
I did a bit, even this morning. So once again, I got a really good article from Morgan Housel via Farnham Street. I really like this quote, and the link is out there for people to read the entire article, but it goes like this: you don't win by predicting the future, you win by getting the odds right. Bet on the one more likely to win than most people expect. That's the one that gives you the best odds. That's the best that pays off over time. That's the bet that pays off over time. And I just thought about, let's embrace that we do bet. I think, yeah, it's betting. It is odds. It isn't 50% or 60% winning trades. It's getting those odds correct. And our systems give us the best odds, way, way better than concentrated positions in the S&P or buy and hold an index, even though a lot of times it doesn't look like they are the best odds. But I've always embraced that it's a bet.
Yeah. No, I mean, I think that's a a good way of phrasing it. And I think, going back to our typical topic about narrative and how story is important and so on and so forth. I've always thought that once the facts became clear, the choice should be obvious. But it seems like when it comes to trend following, it's a little bit harder for people to embrace, because I do think the facts are pretty clear in terms of the value of having trend following inside your portfolio. Yet there are still lots of people who don't embrace that, which is what we're trying to change, of course, with our little podcast here. But I know I think Morgan Housel is spot on in the way he put that. What else did you have?
Well, just a few weeks ago, I kind of complained in a tweet about how a lot of times in traditional money management, it's in their best interest to portray investors, quote unquote, as these amazing people and ethically and morally superior to speculators or traders. And I think that's just kind of crazy. And I think it's ironic that the safest, best, most diversified strategy available for investors is one that utilizes lots of futures and and can access leverage and shorts. And these things sound very problematic and very scary terms, and yet it's the truth. Long only the stock market or bonds is not as safe as what we do, and stocks have had a great run, but it's not always going to be this way. And so I think terming it as a bet sounds, oh my gosh, there you go again. It's a bet. Well, I bet in Vegas. I gamble. Yeah, well, you don't have to acknowledge that when you buy some stocks, that you're gambling, but you really are. And I think looking at it as a bet, which insinuates to me small losses, money management, principles, maximum risk size, and try to preserve capital, and at the same time try to make money. I think these are all great ideas, and I don't like the way we're portrayed sometimes. And it's just purely for people who know better, but it's in their business best interest to use these horrible terms and try to portray us as something that we're not. Okay, so I'm off my soapbox. Sorry.
No. I was just thinking as you were talking. I'm just thinking. So, what do other strategies say that they are? Right? Are they saying they're not betting, for example? I mean, is that how they get around it? I mean, if they did, it's a little bit disingenuous because we're all betting.
They're investors. Investors for the long term. We made fun last week because Wayne had this very good tweet how it's sort of like, if a trader puts a trade on, at the same time the investor puts the trade on, if it goes against the trader, he takes a small loss. The investor may have wanted, had the same idea about the trade, but he can sort of put it in the investing bucket, which is long-term, hold it for years, maybe you'll lose more money. Taking small losses doesn't sound right because the company is still good. It's still a great company. My fundamentals are still great. And so, it's just all hogwash, in my opinion.
Yeah. No. Very true. Very true indeed. What else caught your attention, or maybe the attention of people that follows you on Twitter?
Sorry, my bird invaded us.
That's okay.
I had a feeling she'd get out one of these days. This is a good article from the Financial Times that I read a few days ago. A good article for us. The standout hedge funds this year have been computer-driven trend followers, which are on course for their best year since the credit crisis. Such funds do not balk at highly priced assets, but instead latch onto trends in the market wherever they lead. Asset prices may appear to make little sense, but for as long as the central banks are looking at ways to loosen policy even further, it is risky and costly for investors to bet against them. A lot of good stuff there.
Yeah, it's nice for a change to see an article that describes what we do in a positive way. So yeah, definitely I'll check out that article.
I don't think that we don't look at it as we're balking at highly priced assets. I think that's a value and value idea, and we sort of balk at looking at the markets as if they're highly priced or low priced, or if a brand new breakout signifies, well, that's a high price, or after a trend, a pretty decent trend, well, now it's high priced. We sort of balk at those sort of general ideas and just follow the prices where they may lead. And I think a lot of the good trends, regardless if central banks are involved or what the perceptions are in the marketplace, asset prices frequently appear to make little sense. And so I think that's another edge we have, is we assume that the fundamentals and the popular views may not be what's going to prevail in the long run. And when we're right and we get those odds right, we get some really nice outlier trades.
I mean, the funny thing is, of course, that most strategies, we're all kind of trend followers, right? Because we're all trying to make money from a directional move in markets, right? We just define the rules and we follow them slavishly, and therefore we are quote unquote called trend followers. But all the other guys, they just have different mechanism, but they're still trying to, for the most part, unless it's some kind of arbitrage strategy or whatever. But for the most part, they're making a directional bet on something. But of course, their approach can be described in perhaps more fancy words than following rules and putting these rules into computers. It doesn't maybe sound as exciting as some kind of global macro strategy or something else. But at the end of the day, we're all trying to make money from directional moves to a large extent.
Exactly. And maybe the CTAs, in my opinion, are a little bit more conscious of the risk and preserving capital and not allowing a 50% drawdown or not having a 10-year period where you lose money like stocks.
And I think that's an important point you mentioned there, Jerry, because I think a lot of people are not aware of the fact that we kind of start with the risk, because that's the only thing we have a chance of controlling. We have no control over the returns. So the risk is really where we focus a lot of our attention. Yet a lot of people believe that what we do is more risky. And it's back to this discussion and relentless debate about whether volatility equals risk or not. And of course we say it doesn't, but a lot of people feel that they do. And of course it all ends up in everyone judging an investment strategy based on the Sharpe ratio. And for many good reasons, that's probably perhaps the worst thing you can do in the very long run, because what might have a high Sharpe today and look safe, like Bernie Madoff did before he completely crashed. So Sharpe is something that needs to be taken with a large pinch of salt. Yet everyone wants to use that as the measure of risk-adjusted returns. That I think is a problem.
Yes, and this leads into a good tweet from Wayne, and we could probably end with this one because it's very good. He's an endless source of great information and tweets. Quote, I have had a hard time with endless investment presentations that talk about their investment edge and philosophy and related benefits for pages, and at the very end throw in the requisite risk management slide as if that wasn't all that matters. Risk is not page 17, it's page 1. And I go on to comment, and risk is not page 17, it is page 1, and it's intertwined throughout pages 2 through 17 as well. And I think that's what trend following is. Where does the risk start and end? It's like intertwined throughout everything that we do. Every decision we make is based upon capital preservation, taking small losses and diversification, shorts, huge part of the risk control, longs, even making yourself limit your decisions based totally on the price of the market is a huge risk. How many times do we? I was on vacation this week, and a friend of mine was buying Bitcoin at the same time I was selling Bitcoin. So at least I'm not buying when it's down. My strategy won't work. The price is telling me, okay, I'm not happy. My long is losing money. But it's great information to know, Jerry, do not buy. This is not going to fit in with your strategy and your odds the way you set it up. Hopefully, my friend, it works for him. But so just submitting yourself to the discipline of price is so huge. And then I sit back over the past 35 years when we make money, like this bond move is a primary example. It's sort of like you're helpless. Look, all this money is rolling in and you're not doing anything. You're just sitting there watching and not screwing it up. So there's nothing as risk conscious as we are, as the trend following is, the diversified trend following especially.
Sure. If you allow me, I want to end with one of my own tweets this week. So a rare occasion where I did something that wasn't related to one of our own episodes, but I was listening to a great episode with Aaron Fifield and Larry Haidt, and Larry is just a great source of trend following wisdom. And they got talking about risk management, and Larry goes on to say, I go from where I enter to where the stop would be divided by my core capital. That's really third grade shit.
Well, I didn't want to bring up Larry, but I love Larry. I had a chance to meet him. I remember when I first got in business, February 1988, Mint was around, so they were my heroes. I actually had a chance to meet Peter Matthews at a MFA conference in the 90s. Met Larry Haidt 5 or so years ago. Great guy. Can't wait. His book is out. I thought it was going to be out this week, but it may be.
Yeah, I think it's close.
It's close.
Yeah.
But another quote from that that interview that I really liked. But this has opened up a can of worms because we have to come back. We talked about this really fine article that you and Kirk wrote at Cantab. We talked about it last week about complexity, which the markets are very complex. The world is complex and complicated. And I think what we do is complicated. The systems need to be somewhat complicated. And once we work on them for so long, we do have a tendency to look at them and say, wow, they're a lot less complicated. Or maybe my thinking is more clear and less complicated than it was when I first started. So, but anyways, this whole simple, not simple stuff is up for debate, I suppose. But I had another one that I really liked, and he said, simple has a very bad reputation. I'll tell you what simple really is. It's robust. I like simple shit, yeah. So I really like that. I think I know what he means, but, frequently I'll have debates or emails back and forth with my friends, some of who you know, and they'll pose a question to me about money management or stop placements or position sizing, and then I'll give them my response, and they'll go, oh my God, I had no idea. This is how you guys are doing these things. And I'm like, yeah, it's a lot more to it. It's a lot of sweat and pain over the years to refine this stuff. So, kind of simple, but following prices is simple, but it's more to it than that, let's say.
Yeah, and I think people should always remember that things that are simple doesn't mean that they're easy to do. I mean, that's the problem. So, anyways, great stuff. Now, let's jump to the questions. We got a few, so let's just jump right in here. The first one is from Eric. Eric goes, hi, guys. I love the show. I have really enjoyed learning more about systematic investing. I had a simple question. What are your thoughts about hedging positions with OTM put calls? ? Also, what about taking positions using calls and puts as opposed to outright long short positions in markets with liquid options? It seems like in the money call has a similar risk reward profile as a long position with a stop. Totally unrelated question that has also been in the back of my mind. I fear algo trading machines will learn widespread trading system rules and front run or fake out people following widespread trading systems and whittle out profits. Is the fear founded? Thanks, and keep up the great podcast. Thanks, Eric, for that. There's a few questions in there. The first one, I guess, is should you implement what we do using options rather than futures? The second question is about whether algos might come in and impact what we do. So what are your thoughts on that, Jerry?
Well, I'm certainly not an option expert. I think options do have this volatility piece to it that CTAs or trend following in the futures markets or cash stocks don't really have as much of, let's say, like we do. I do use volatility in the markets to set my initial position. But I think maybe options, obviously a little bit more involved with the volatility. Maybe it's, I've heard people say it's like almost all volatility. And of course, trend following has been described as option replication. Small losses, unlimited upside potential. And I've sort of said, it sounds maybe like it is option replication without having to pay the premium. I think paying the premium is the problem. And getting that right and having your option profits overcome the premium that's the deal. I mean, that's hard to do. And I guess the third piece I would say is that you know what you know, and we know this game that we play and the back testing and looking at the historical, how the systems have performed historically and with lots of data. And so I think that's probably tougher in options. I don't know, and I definitely agree with the last part that it is possible. There's algos front running or whatever, but they're probably over time probably not going to be any more accurate than we are, let's say, as far as it's okay to try to front run me, but I can also defend myself, and that's sort of our job, is defending ourselves and not being subject to that as much as we could be if we just sort of ignored it. I definitely have never been in favor of this idea that there will always be trends. Well, that's half the equation. There'll always be trends, but it's up to me to sort of figure out a good place to buy, a good place to exit, and not let bad algos destroy my profitability.
Yeah, absolutely. And I think that kind of ties into my thoughts on both questions, really. And that is, I agree with you. There's going to be people who are going to try and whether it's front running or whether it's trying to get trends back to the mean and get us stopped out or whatever it might be. That's perfectly fine. That's how markets work, and trend following will survive that, one way or the other. I'm sure of that. We always have to be better, or become better, and innovate and all of that. And that's what research is all about. But back to this call, this option implementation thing. What I find is that I think from a practical point of view, I think it'll be incredibly difficult to do, because our trading models are based on when certain things happen in the futures price. Do we get stopped in? Do we get stopped out? Et cetera, et cetera. And I just don't see that easily replicated in options markets. Certainly not in an automated fashion. And so I think if you are maybe a longer term investor or manager, but not trying to be a systematic CTA, but wanting to use trend following as a concept, and if you were really smart and were able to get more out of doing it in options, possibly that could work. But if you're trying to be kind of a pure systematic CTA trend follower, I think sticking with futures where you can do all your back tests, that it's this thing about testing what we trade and trading what we test. I think that those two are quite important. And so disturbing the picture with options, even if you can increase the output a little bit, I think the complications of that would be far outweigh the advantage. But anyways, it shouldn't stop you, Eric, from trying if that's what you want, of course. We've got Sam back in the house. And
Sam's never left the house.
He's never left the house. He's still here. Okay, so he's referring to an episode which you may not have heard, Jerry, but I released an episode with a short-term manager. Well, he's both short-term, but he also has a trend following program. An Australian guy, great guy, Alan Sheen, who I think I released part 1 this week, and part 2 is coming out in a few days. I encourage everyone to listen to it, of course. So Sam goes on. I listened to the episodes with Alan Sheen this week, and he provides some facts about his strategy that relate to something I brought up in the past that allows for comparison. He says his trend following trades on average are about 6 weeks and uses a 3 ATR initial stop. I think we all might agree that average holding period is actually pretty short term. Regardless of that, conceptually, do you think the same distance from entry can be used across multiple/all speeds of time frames traded? For example, if one is trading both a 6-month and a 12-month look back, or 100 days and 250-day look back breakouts, is it okay or common for the stop distance to be the same daily ATR multiple for both? Isn't it inherently logical for me? This isn't inherently logical for me to think they would be. One is trying to capture longer trends, the other, in my mind. So I tend to think that one will get a wider stop with a smaller position. I know you all said you like the idea of risking the same per entry regardless of the look back or time frame of each, but that's only part of the position size calculation. The other is the actual distance in price. All right. You are more of an ATR trader than we are. So what is on your mind when you hear Sam's question? Meaning, really, are we keeping the stops proportionately the same regardless of time frame? That's kind of how I sum it up.
Yeah, well, I didn't listen to the interview, but initially when you described it, I thought Sam was saying that this trader's only exit was the 3 ATR. So I use like an ATR for my stop loss, and then once it's a profit or goes up, the moving average crossover or breakout kind of kicks in. So, my initial reaction would be to what works best in the back test, Sam? Is 3 good with a 12-month look back, or is the computer telling you, no, it makes sense from the computer's point of view, the back test results, that the 12-month look back needs to be paired with a longer-term ATR stop loss, So I'll put 6 with the 12-month and 3 ATR with the 6-month. I mean, it should sort of pop out and tell you. I doubt if it's going to say that, but that's where I would look. And then I would use 3, 4, 5, 6, whatever ATRs you want. I'm happy with that because that just gives you that more diversification. And I'm sure that the 3 through 6 ATR stop on the back test would have slightly different results and a higher winning percentage for the 6 ATR and lower winning percentage for the 3 ATR. They kind of go together, So, but it's going to give you more diversification on the stop loss. It's a minor thing, but it's worth doing in the same way that the 6-month look back and the 12-month look back make about the same amount of money probably over a long period of time. But in certain trades like these bonds where you have massive profits and it's dominating your performance, and booking this profit and getting out at a good price matters a lot. The exit's going to matter a lot to your P&L. This one random trade exit, you kind of want to mix up where you're going to get out. Sometimes you're going to get out at the 6-month low or look back on the 6-month prices, and it's going to go straight down after that. And so you're happy. And sometimes it's going to go back and make new highs. And so you're kind of halfway happy because you got out of half and you kept half. So this sort of, we're all in favor of multiple entries, multiple exits. Somehow I've given people the impression that I don't agree with that, but I agree with everything trend following plus nothing, with multiple entries, multiple exits, multiple stop losses. It's, as long as it kind of looks good on the back test.
Yeah, no, I mean, I agree with all of that. I would add to it and say that I've certainly also on my side seen the benefits of having tighter stops or looser stops initially, for sure. That really does provide some diversification. But I think also the other key takeaway, maybe Sam, from what Jerry said is that, and correct me if I'm wrong here, is that you can also have different types of stops that kick in once you have moved away from your kind of entry price and you're in the trade and you've been there for a while. Then maybe the original way of where you put your stop goes away, and there are other rules that take care of where you want to get out eventually. So keep that in mind as well, that it's not all about just having one type of stop at all times. I think that's an important takeaway as well. Yeah, cool. Thanks, Sam, for your question as always. We have a question from, and I may not pronounce the name right, so I apologize in advance, but Nouby, or Noob. And the question is, a few weeks ago, you 3 wise men noted the challenge a new systematic manager is most likely to struggle with is staying in trades when the position gets hair on it. Okay. To that end, are there any contracts you may recommend a new manager avoiding until they get some experience? Let me kick in on that one first and just say, one of the key things we're also saying, I mean, there may be contracts that are simply too big and you need to be depending on account size. But as we always tell both our potential clients, our clients, and here on the podcast, is that we size our positions proportionate to the risk or the volatility of the market. So, in theory, one market is not more risky than another market. So it's not like one market we would shy away from. If you have a small account size, that's different because there could be contracts where it's it's difficult to get, less than one lot to do that, even though nowadays they come out with a mini this and the mini that. So the exchanges try and work around those things. But just in general terms, we don't, and this is actually an interesting point that comes up of that, because I was recently, a few months ago, someone came to me and said, well, if you, and I phrased it a little bit differently, but basically they were looking at managers, and they felt that a manager like DUNN would be more risky because we trade more commodities, and compared to a manager that would trade just financial markets. So in my view, they've got it completely 180 degrees wrong because of two things. One, we size the positions the same, meaning we take into account the volatility of the market. So whether it's sugar or whether it's short sterling, it shouldn't matter. The second thing is, of course, that commodities are the least correlated markets in our portfolio. So in my opinion, at least, I would say that we have a lower overall risk in the portfolio. Doesn't mean we can't lose a lot of money like anyone else, but it just means that we have more strings to play on, because commodities really do offer some very low correlation or negative correlation to many of the other markets we trade. But I understand why people sometimes feel that because it's a commodity that it must be more risky. And maybe it's because we all now see how the Fed is, managing expectations and making equity markets look ultra safe. I think that's a false safety. Same with the bond markets. I mean, at some point, this could well blow up on all of us. Like the currency markets did many years ago. Suddenly we had, a real volatility, certainly back in the early 90s and in Asia in the late 90s. So just because it looks safe doesn't mean it is safe. And the more diversification, like Jerry was talking about, entries, exits, markets, the more of that, at least in my opinion, the more robust and the quote unquote safer the approach.
Yeah, I mean, commodities are the best. There's nothing like them. They're not that correlated with each other. And so I think even though I do my best to put together a portfolio of single equities that are highly diversified, so I'm going to try to tilt the odds that where I'll have some longs and some shorts and some flat positions. And I've even come up with this stupid idea that I want to be short in the biggest bull market of all time. I'd like a few shorts on, and that's proven that I've done a decent job, hopefully, of diversifying my equity markets that I trade. So, but you know what? Regardless of the numbers, the historical numbers that I run and how I put my portfolio together, there's going to be a day, multiple days in my recent past where every single stock is just getting crushed for a day or two or a week. Very unlikely in the commodities. It's possible. There has been days where there is a theme in all the markets. And every market I have on, even the commodities, I'm losing money because this overall theme of economic expansion or whatever the panic of the day is, it's going to, it can take over some of these markets. But having shorts on, even if it's a short commodity and a long stock, that's less risk than having both be long. So the shorts are very important as well. But the commodities are great, and like Neil said, the most diversified. And that actually, I've had that same conversation before with the client. I've told it on the podcast where I wasn't able to trade commodities for one of my clients in 1994, I think, and we made 15% in coffee. And for everyone else except this one client who said, hey, I wanted an account with no commodities. We're like, sure. And then they asked me at the end of 94, how did the rest of your clients make 15%? And we broke even. And I told them about coffee. It was all in coffee. And they said, well, we thought commodities were really volatile and really risky. We told them, gave them the explanation Neil just gave. And they were like, okay, trade commodities for us. So this is the typical, this happens to me, it happens to all of us humans on this planet. We hear it, but until we experience our mistakes, we're slow to change. So they got the religion pretty quickly that more diversification is better.
Yeah, absolutely. Next question comes from Clay. Clay writes, had a quick question. Was thinking about the systematic space and various strategies and got me thinking about you guys or brackets DUNN and others about how your day is filled. Turnover is relatively low, so assuming majority of the time is spent researching client interaction, tweaking systems and trying to break them. Just curious, as was thinking if when I launch, I have a decent amount of time on my hands, despite having to initially wear multiple hats, PM, trader, liaison with my prime, broker, outsource compliance, administrator, etc. So Clay, I mean, you're right that in terms of activity, the implementation of trades with a longer term trend following system, is obviously not going to take up all of your day. Clearly, as your size grows, there will be more, and we certainly, obviously we have a full-time trading staff covering all hours and so on and so forth, and I would say on average we probably see small trades in half the markets we trade on a daily basis. But it doesn't mean that's what the traders are doing all day. But there are lots of other things they need to do, and then of course, as your business grows, then there will be lots of other things that you need to cover, and that's what people do. But it is true, and I've heard this said on other podcasts. I think actually on Mike Covell's podcast, that one of the first things he noticed when he came to our offices many years ago was it was like stepping into an accountant's office. Very quiet, nothing exciting going on, and that is true. I mean, there is this. It's not like what you see on movies when you see about trading and all of that. I think that's what people might think it's like, but what we do is in many ways very boring, and boring is good. So yeah, I hope you do launch, and I hope you have lots of time on your hands to continue your research and wear all the other hats that you need to wear. Launching is tough. It's become even more difficult, I think, nowadays, and I think one of the hardest things that firms, even established firms, one of the hardest things to do is not necessarily to come up with a system that is okay. It's building the business. The business side I think has increased in complexity. Finding clients, I think, is incredibly hard at the moment. There's so much resistance because people tend to want to buy the safe things, the big brands, the strategies that they're most familiar with, which is another interesting topic. I mean, that you should probably buy things that you're not that familiar with as well. Yeah, but it's an exciting journey if you do start it. Anything you want to add to that, Jerry?
Yeah, it's just so much there, so much to talk about. We need to dedicate another show to that subject. Yeah. I think we did one, or we spent a lot of time on this, but definitely, you got to cover all your bases. Regulations and compliance is a big deal these days, more so than when I was around. And you want to put a lot of concentration, a lot of your energy on the systems and the trading, and then as quickly as can find competent, talented people to help you with everything else. Just don't take your eye off the ball of the trading and the research. That's the most important thing. And there's so many things you can get distracted by. I think over the years, our biggest distraction was, lots of separately managed accounts. It's just a plague. CTAs need to have most of their money in a fund like all the hedge funds do, and maybe a few really large, substantial managed accounts, because that sort of administration and the cost and the distraction can weigh on the firm. You should never have a client dictating to you that you can't trade stocks, that you can't trade commodities. And this is all just signs of, clients that unless you can make a change, you need to I know I look back over time and think, anything that compromised my best ideas, any person or any client or any structure or managed account or fund that didn't allow me to implement what I thought was correct and do the best for my clients was a total mistake. You can hear my voice rising. I'm getting exercised here. And so, don't do that. If you end your career with a $50 million under management, $100 million, a couple, small firm with just a couple of people, and all the money is in your fund, and you were able to do the trades and have the portfolio that you thought was correct, that's a hugely successful career. Sometimes the bigger you get, it's just impossible not to make unfortunate compromises.
Yeah, I think that's really important, actually, and I think that's great advice. That size is not a determinant of success for sure. And I think that also shows, Jerry was talking about how his voice changed when he gets into that. That's the other thing that I think is really important, and that's just passion. Be passionate about what you do, stick to your guns, and don't let, anyone tell you that, you're doing it wrong. If that's the way you want to run your business, if that's the way you want to do it, stick with that. Authenticity in general, by the way, I think is much more attractive than trying to mirror or mimic what other people are doing. So anyways, last question, and I'm definitely going to butcher this name. I apologize in advance. I have a feeling it might be Italian. I'm not even sure. But Gaitana, something along those lines. Apologize if I didn't get that quite right. Nevertheless, your question is in perfect English, so I'm going to read it instead. Having stops did not mean that the turtles always had actual stop orders placed with the broker. Since the turtles carried such large positions, we did not want... Oh, by the way, this is something he found in a book I'm quoting. It's a quote. Apparently. Sorry about that. I should have said that. So the quote is, having stops did not mean that the turtles always had actual stop orders placed with the broker. Since the turtles carried such large positions, we did not want to reveal our positions or our trading strategies by placing stop orders with brokers. Instead, we were encouraged to have a particular price, which, when hit, would cause us to exit our positions using either limit orders or market orders. Now, you can, of course, comment, Jerry, because you know whether that's correct or not. But what our listener is asking is this the best practice nowadays as well? Or essentially, should you put your orders with your broker in advance?
Good question. Yeah.
What did you do back then when you were trading for Rich? Were you saying, okay, the stop is hit, let me go and do the order, or did you leave orders with, or did you do a bit of both? Do you remember?
We definitely would not always put the stops in. It's kind of funny because we were sort of taught how to trade from A to Z. Mm-hmm. Research the systems, money management, execution, and we were taught the principles that if you were trading 1 million or if you're trading 1 billion, these are good principles. So sometimes we acted like we were trading 1 billion, like we'd have a one lot to buy in the most liquid market going, and we would want to work this order, or don't put it in on the open, or don't put it in as a market order, because you'll get this big slippage or something. So we didn't really know we didn't really act like we knew what we were doing sometimes, but. Yeah, so I think, avoiding the opening, the mess of the open, or putting an order in before the open, don't do that. It's kind of a good idea. Wait for the market to open after a couple of minutes or whatever, kind of settle down. I've seen some really bad situations, people putting market orders in prior to the open. That's a no-no probably. I think in something like the Bund, we put in like a stop limit or just do the market order. Nowadays, you've got the algos, and you can program it to start and stop and go slow, go fast, based on volume, based on average price or something. So it's a whole different world now. Stop limits, stops. There's all sorts of ways to protect yourself. I don't really have an opinion. I think I will say that the most important thing in execution that I have found through research is when your target price gets elected, start doing the trade. Don't be too fancy. Don't sit back and say, well, I'm supposed to buy at 50. It's now at 50. Maybe I should wait for it to retrace a little bit. Oh, I missed it. It's at 55. Should I wait for it to come back to 50? These mind games on how you're going to hold this position for 6 months to a year. That's your speculation piece. Do you want to speculate on the execution? I'm not saying throw a market order in all the time. I'm just saying, look, when it gets hit, do the trade. Keep buying higher prices if you have to for the next hour or so, whatever. Markets are cruel. You'll have to buy the high of the day. Then as soon as you're done, it'll go right back down. All these things can happen, but just do the trade. I don't think it's a big deal to how you're going to do it all the time, especially if it's liquid.
Yeah, and especially if it's kind of in the longer term time frame. I mean, often you can do your research and you'll find out that whether you did the trade the day after the signal, it didn't have a big impact on your performance anyway. So again, unless you are very large and trading is a really important part of your strategy in terms of implementation and slippage and all of that, sure. And and some managers, frankly, I mean, I've certainly heard of managers who try and make the whole slippage thing the edge why you should choose them, because they have better execution methods or algorithms or whatever. But I wouldn't choose a manager just because they're good at execution. I would choose a manager who has developed some really robust strategies and have proven that they have worked for many years, like Chesapeake, like DUNN. It's not about the specific price you trade at, in my opinion.
Yeah, you can't trust. I've been surprised at how traders will describe their slippage calculations. You can't really trust some crazy assumptions. But you bring up a very good point, and that is what you said about you do this research and it doesn't really matter if you bought in the open or the close or in the day or the next day and this sort of thing. Mm-hmm. Aha. But the key to it not really making much of a difference is you're brutally consistent. You're doing it the same way all the time. Or you're like a third on the open, a third in the middle of the day, a third on the close, a third a market order, a third a stop. Something like that. That's fine. It doesn't have to be the same, but when you're consistently handling these trades the exact same way, and the computer says, aha, well, if that's what you're doing, it's not going to really matter over the long term, how you do these things. But doing it the same way and consistently applying this technique in the same way that you're going to consistently do your systems. Every time it hits this breakout, I buy. Hits this other breakout, I buy the other half. Well, you're doing it that way consistently every single time, then the numbers are going to be fine for you. But haphazard, randomly, being emotional and doing it this way one time, well, that didn't work, so the next time I'll do it another way. No, the computer's going to say, oh, that matters because you're not being consistent.
Great point. And the other thing I would say, if you have a strategy that is really robust, I think the edge lies within the strategy at that point, so to speak, compared to something where the edge is either speed of execution, so a lot of the short-term strategies where it's the speed that gave people the edge, and as soon as what happened maybe the strategies that started as quote-unquote short-term strategies 10, 15 years ago, where you could see as soon as other people became, were as quick as in terms of execution, et cetera, that edge disappeared and the performance disappeared along with it. So don't focus on strategies where the edge is based on, I think, some kind of technology that can be opted out by just improvements in technology. Find something that is, of course, we would say behavioral based, because it's not going to go away anytime soon. And also it makes it a lot easier in terms of what equipment you need to implement it. Just do it, as Jerry said, just make sure you do it consistently. It's the consistency, doing all the trades, and following the rules. That's the magic. That's where the edge really should lie. Okay, let me quickly run through the markets. Jerry, that was the last question. Or not the markets, the performance so far, as we are getting very close to month end. And then we can think of anything else to bring up. The BTOP 50 index as of Thursday. And by the way, I think Friday was pretty quiet. But as of Thursday, it was down for September 3.04%, still up 9.18 for the year. SocGen CTA index down 3.22, still up 8.57 for the year. SocGen trend down 5.06, but up 13.89 for the year. The SocGen short-term traders index down 1.42 for the month, and up a little bit this year, 1.66. And the Bridge Alternatives Index, the flat fee funds, down 4.03, up 12.03 for the year. Any final thoughts on this Sunday?
Well, I just realized during this podcast that it's so difficult to not have an interaction. We're trying to answer these questions, and there's not an ability to follow up. And so I think this live event, hopefully we'll have some more, is something that people should consider, because it gives you the chance to sort of follow up, ask your follow up, get your clarification. Right. So often I know I'm perceived as not saying something I didn't mean to say. So it'll be fun to meet this group of people and have this back and forth. And one of my tweets from earlier this week, one of our participants commented back, and his response was, "I can't wait to get to the bottom of this when I meet you." So it was my tweet about how as much as we kind of enjoy, well, we kind of want to not give back too much profit in a big profitable trade, we need to be wary of getting out too quickly and getting out too close to the highs, because there is no magical indicator. And the cost of getting out too close to the high is we have to get back in. And that is a new cost. That is a cost of loss of profit, getting back in, resetting the position size to probably something that's smaller than we had on, because the volatility has gotten higher, like these bonds. So anyways, I just think maybe technology-wise, we'll be able to loop listeners in one of these days to where we can be more real-time and get follow-up questions. But so that was my takeaway from today.
Yeah, no, that actually is a good point, and I concur. It's going to be super exciting to meet people and get to really deal with the details, the nitty-gritty details of their challenges, and of course what we will try to do very best. Of course, we need questions from the people participating. We want to address their problems. It's not going to be a seminar where we're just going to talk about concepts. We want to deal with real life problems or challenges. But the hope, of course, is that we will be able to create some breakthroughs for them in either their trading or their business. Combine that with Jerry being in charge of the catering arrangement, so to speak, finding the best restaurants in New York. Should be great fun. Now we have Denise coming as well, and that's going to be so exciting. So if you're still on the fence and you want to join us, send us an email. We have 1 or 2 spots left. Anyway, that does it for another episode of The Systematic Investor. As always, you can find notes and links related to this episode at toptradersunplugged.com. From Jerry and me, thanks for listening. And until next time, buy high and sell low.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next